We Filipinos still have a long way to go when it comes to investing for the future. We seem to prioritize instant gratification, but I think how to invest properly is something that we all need to be familiar with.
It's simple, really. You work today, you invest, then leave better tomorrow.
Besides, investing shouldn't be scary, you know. It doesn't have to be overwhelming. I mean, I started when I was a teen. I hope that I inspire my kids that when they're old enough, they'll tell me that they're excited to do the same.
What's important is to find a good reason to invest. It becomes so much easier when you visualize your goal.
People think I travel so much, and I have a YOLO or you only live once attitude. But the truth is, I travel because that's my business, and I make sure I invest in it, spend time for it, to give people the best experiences they deserve.
When people find out that they invest for what I'm passionate about, they always say, "What?" But I always just tell them that I can afford to fund my passions because of my investments.
The thing is, some people are just too shy to ask for financial advice. Like asking for help is seen as a sign of weakness, when in fact, it's through asking that we learn the best way of doing things, even in investing. With ATRAM, you can engage and be confident that you have a partner in achieving your financial goals.
People usually think investing means buying a house or retiring. Sure, it can, but saving for smaller goals is another way to do it.
People think investing is expensive. Nowadays, even with a small amount of money, you can already begin your investment with ATRAM. It's easy to make it a monthly or even a weekly routine. ATRAM makes investing simple, even for busy moms like me.
And even if you're always on the go, like me, you can keep an eye on your investments online. Plus, I'm confident that ATRAM, my trusted partner, will take care of my portfolio and make sure it gets invested in the right place.
Never settle for average. Why? Because life is what we make it, and a strong investment partner can help us live the life we want.
ATRAM is dedicated to delivering an investment experience that helps people get more out of life. In fact, it was built with that single focus, to help clients attain their investment objectives. We see Filipinos invest in their dreams and aspirations. With ATRAM, building the future is a task we can surely take on.
With ATRAM,
You
Can take on tomorrow.
Hello and good morning, everyone. Thank you for joining us this morning. I am Mika Koga, Portfolio Solutions Officer and your host for today. Today's session is dedicated to ATRAM's best performing mutual funds for the year 2020. Stay tuned as we present to you our best strategies. I am sure you're interested to learn more about ATRAM's funds. If you have questions, you may send them as early as now by clicking on the Q&A button found on your screen. Before we begin, I would like to let you know that this session will be recorded and that copies will be disseminated within the day as well as posted on all our social media platforms. Please feel free to send your questions all throughout the webinar, as we have a special surprise for all of you. Each question you send is a raffle entry for a chance to win ATRAM merchandise. Winners will be announced at the end of the webinar, so make sure to stay until the very end. With that, let's begin. We are joined today by members of ATRAM's investment team. We have from the Equities team, ATRAM's head of Equities, Julian Tarabago Jr. Joining us on the other hand for the fixed income team is Miguel Leboro, the head of fixed income strategies, as well as Devi Ulpo, senior portfolio manager for fixed income strategies in ATRAM. Last but not least, we have Ivan Ante, our senior portfolio manager for local and global multi-asset strategies. So very happy to have everyone. Thank you for joining us today. Now that we have introduced members of ATRAM's investment team, we will begin with today's discussion by taking a look at the performance of ATRAM's funds last year and their ranking against the benchmark as well as other peers. So despite the volatility in the equities market, broad market trading within a certain band for the last 5 years, The ATRAM Alpha Opportunity Fund, managed by June Tarabago, has generated a 5-year cumulative return of 12.07%, outperforming the benchmark by a whopping 30.56%. Clearly, the fund has outperformed its benchmark by a huge margin. So, how do you think it is faring against its peers? Aside from beating the benchmark, the ATRAM Alpha Opportunity Fund is also ranked first in all peso equity mutual funds. Given its track record, we can say that it is the best performing peso equity mutual fund for a 5-year return perspective. At this point, I would like to call on June Tarabago. Hi, June. Thank you for joining us.
Hi, Mika. Happy to be here. Good morning, everyone.
Just have a couple of questions for you. I'm sure our viewers are interested to know how you were able to beat the benchmark as well as peers on the space. So please do share with us your strategy and let us know what really sets the fund apart from the others.
Yes, thanks for the question, Mika. I think the ATRAM Alpha Opportunity Fund has essentially weathered, I think the strategy has weathered good and bad markets. It's outperformed its benchmark, PSEI, and the MSCI Small Cap Index, and all other Philippine equity funds over the last 5 years. I think simply because it has a very clear strategy it's managed consistently aligned with the strategy, which is to always have a clear view on the market and to use ATRAM's comprehensive and intuitive fundamental research capabilities to invest in one, the fastest growing companies in the market. Number two, in what we think will be the future blue chips in the market. And number three, in transformational themes, which right now seem to be, aside from reopening, it's really companies related to the new economy, like you have Converge and a couple of other companies there, and also and lastly in ESG or sustainability or regenerative investing. The fund has investments in companies with high ESG rated companies, such that we view ESG as a risk measure, and also there's growing evidence that the companies with high ESG ratings perform well over time. So this strategy of investing in the fastest growing companies in transformational themes is different with the typical equity funds in the market you have today, whose strategy is essentially to make bets on either higher or lower that of weights of the stocks in the benchmark or the PSEI. So it's broad index-based investing for those funds. This one is really utilizing our internal intuitive and deep research capabilities to actively invest in companies, the best and fastest growing companies. So this process has allowed us to come out winners in both good and bad markets consistently, and allows us to spot or discover winners, stock winners, such as I think a very popular stock now in the market is AC Energy. We were invested in AC Energy even before the run-up of late companies like Wilcon, Megawide, and today I talked about New Economy. One of the best performing stocks today, as in right now, are IMI and Converge, which we think will continue to do very well. So yeah, that's allowed the fund to do well, not just on a 1 or 2 year basis, but consistently over 5 years. And I think that's what you need in an equity fund.
Yes, absolutely. I mean, the volatility, it's crazy, especially since last year the equity market dropped 40%. So the strategy is all about investing in small cap, and it is positioned, these investments or these stocks it holds
But Mika,
are the future blue chips.
Yeah, just to maybe clarify, it's not just to invest in small caps, but it's essentially a growth fund. Just maybe to put that very clearly, it's investing in the fastest growing companies. So it's invested in small caps and mid caps because, structurally speaking, small and mid cap companies or smaller companies are structurally primed to grow faster than the larger companies. But of course, there's a great deal of risk management involved. in managing the portfolio.
Okay, thank you for clarifying that. So it is invested in the fastest growing companies as well as the future blue chips in the Philippines. So how do we then vet, the investment outlet, and what is the investment process like?
Good question. So the process starts with the people. So we have a trusted team of dedicated analysts and portfolio managers to really comb the market for bargains, for deep value, for high growth potential. We have a dedicated internal equities research team, which covers 10 sectors, and more. This team last year did more than 300 company visits. Of course, a lot of those were virtual. But even before the lockdowns hit, we were doing roughly 300 company visits per year in past years. So, I mean, who does that, right? This process is deeply rooted in fundamental research, rating companies on the basis of the industry, growth, management quality, risk, and valuation. And I mentioned risk. Risk is very, very important because if it's a smaller, mid-sized company, can't invest in companies that have questionable management. We only invest in companies that we think have high quality. This is embedded in our investment process, and it allows us to identify red flags and avoid future potential disasters in the fund. So that's why even in bad markets, it's performed quite well. And well, at the end of the day, this again, I talked about people earlier. The investment process and portfolio management is guided by more than 50 years of cumulative or combined investment experience in Philippine equities. I alone have roughly 26 years of investments experience in the market, and our CIO has a bit more than that. So yeah, it's experience, it's process, it's people, and it's intuition.
I completely agree with you on that. It's not just the process that matters, but really the people monitoring the process as well. We need the human perspective as well as our systems in place to make sure that everything is in line and monitored well. I have another question for you. What is our return perspectives for the year as well as our outlook for Philippine equities?
Okay, thank you, and very timely question. I think given that we are kicking off the year, and not on a very encouraging note, if I may add, if you recall January, the PSEI was down by about 7.5%, and not very encouraging. And people say how January goes is typically how the rest of the year goes. I beg to disagree. I actually think the PSEI will give substantial returns this year, to the tune of 8,300 for the PSEI. I know that may raise some eyebrows and comments, but that's supported by I believe, our team believes to be sustainable sequential improvements in GDP. We're looking at GDP growing by 9% this year. We're looking at an earnings rebound for corporates of about 45% this year. And we think that given the recent developments, consumer confidence is slowly returning and will be back in a big way, especially next year. You also have still a healthy balance sheet for the Philippine economy, low national debt levels. You have high dollar reserves for the Philippines, record highs still. And these will usher I believe, the eventual return of foreign inflows in the country. And foreign inflows now are currently at 9-year lows. So it's going to be very easy for the PSEI to bounce back in a big way if only we get a trickle of these foreign reserves, foreign buying that has left the country, or foreign investments that have left the country. And if that's not enough, you have a national election, which we think will start seeing the benefits of starting the fourth quarter or second half of this year, carrying over into next year. And with that, we're still cognizant of risks, which in my view are still inflation, rising NPLs for banks, or asset quality issues for the banks, and rising bankruptcies and extended lockdowns. So yeah, I don't want to take up any more of your time because we have you have more guests. So yeah, I'll cut it short at that.
Thank you for that outlook, June, and for sharing to our audience the strategy for the ATRAM Alpha Opportunity Fund. Now let's move on to
Welcome.
fixed income and take a look at the best performing funds in the space. So the Soldiva Bond Fund, which is managed by Miguel Leboro, has generated a return of 8.06%. I would say that that return is very decent, especially for a bond portfolio. Why is that? Well, gone are the days when we could hold a bond to maturity and generate double-digit returns. Yields, as we know it, have come down. In fact, if you were to buy a bond, a 10-year bond, the coupon rate based on the recent 10-year auction averaged at around 3.06%. Would you be willing to buy a 10-year security that only gives you 3.06%? You know you can definitely do much better than that. And today we will share with you how. So aside from generating that 8.06% return for 2020, the Soldiva Bond Fund is also ranked first in the peso fixed income funds with a medium-term time horizon. Let us now call on Miguel Leboro to share with us his strategies, as well as to help our audience in doing much better than 3.06%. So Miguel, good to have you here. Thank you for joining us.
Hey, Nix. Morning.
Yeah, morning. So let's just start with the first question. Basically, how are you able to generate such returns, and what are the key features and fundamentals behind the Soldiva Bond Fund strategy?
Yeah, thanks. I actually had something planned, but the statement you just made actually raises a very good point. Would you buy 10-year at 3.06%? And the answer to that is not with any intention to hold it to maturity over the next 10 years. But would I buy it at 3.06% if I felt that yields could go lower in the short term, and then I could sell it in the interim and generate capital gains? And the answer to that question is yes, absolutely. And that feeds into your main question. How are we able to generate returns of last year above 8% in a market where 20-year bonds were not generating an 8% yield to maturity, even at the beginning of the year? It's because we're able to spot those types of opportunities, make the determination on the general direction of interest rates, and identify the good risk-reward propositions to be able to generate those returns for the fund investors. Last year, as we know, interest rates moved very drastically lower on the back of COVID, with the BSP cutting interest rates lower and lower. And because we did make that determination early on that rates were probably going to adjust lower on the back of everything that was happening, we were loaded up for a brief period of time on longer tenor bonds, which generated those capital gains. By the end of the year, we had almost none of those longer tenor bonds. So we were buying 10-year and 20-year for a brief period, and by the end of the year, had none of that.
I based on what you just said, I would believe that the best feature really is active management, right? Spotting in opportunities and making sure we kind of take those gains. So aside from active management, what do you think sets the fund apart from other fund providers?
In 2020, the performance. No, I'm just kidding. Yeah, 2020 was a good year for us, and it's not always a great year all the time. So I'm trying to milk it. No, I think what sets it apart is that I'm not going to pretend to know that I've seen every competitor fund in the market out there. But broadly speaking, I think that most investors present can agree that fixed income funds are categorized very, very broadly in three ways: short term, medium term, and long term. And all short term means is that the fund won't buy anything longer than 3-year bonds. Medium term means it won't buy anything longer than 5-year bonds. And long term means that it can buy any tenor of bonds. What we do in ATRAM through active management is we don't really make a distinction between just short, just medium, and just long. And the Soldiva Bond Fund is a combination of that type of active management, but also with a very clear cognizance of the fact that it's an intermediate term bond fund, that while we encourage investors to be longer term investors, they could potentially be investing for just a short period. And that's why there's also a corporate bond component of the fund, which is really just there to bring the yield up passively and to provide like an anchor of stability, so that it's not the whole fund that's moving around all the time. There is a portion of the fund that is just very stable and providing that interest income, so that there's that stable appreciation of the fund. And I think that's what kind of sets it apart. It's a balance between that kind of stability, but also the active management that we've been discussing.
Okay, so aside from trading the securities, actively managing them, you have a stable component that preserves the fund. Lastly, please share with us your outlook for Philippine fixed income and your return expectations for the year.
Uh, I would love to say that another 8% is in the cards, but interest rates were a lot higher at the beginning of 2020 than they are today. So while I do think that in the short term, rates will continue to move lower, I don't think they will move lower by as much. And I think that there's a chance they could start moving marginally higher. As June mentioned earlier, we're quite bullish on equities. We do think that the economy is on track to recover. And we think that on the back of that, you could see a little bit of an uptick on inflation. But we're not really afraid that it's going to get out of control at this point. It's something we're monitoring. I think definitely that there's still a case to be made for Philippine fixed income, even though we are constructive on equities. It's very hard to say what will happen, especially because COVID is very much still in the cards. So for return forecast, I would say somewhere between 3 and 5% may still be possible, which I think is still quite a respectable return, and I think would still serve investors well to have that kind of diversification component in their portfolio, to anchor their portfolio in stability, even if they're able to take risks longer term on the, quite frankly, better risk rewards in the equity market at current levels. You still have kind of that core there to ensure that if things don't pan out, at least a portion of your portfolio will be reasonably insulated.
Miguel, I have another question, sorry. So inflation affects the interest rates of the market. We don't see interest rates appreciating like how we did in 2017 for this year, right?
Yeah, I think that's the risk that you're seeing. In 2017, we had inflation at around 3%. In 2018, we went up to above 6%, and then in 2019, we went back down again to where we were last year, which was sub 3. And today, inflation is finally back above 3. As of the last print, it was actually at 3.5. We actually think it'll stay around here for now, between 3 and 3.5%. On average, we certainly don't think that it will dip below 3% again like last year. And that's why I'm saying that the risk is probably that it will probably stay around here. But if the economy actually does improve to the extent that we're hoping it does, it could potentially go higher. And I guess that's the risk, and why I think an active management strategy would still be the way to go here. Because if that does happen, then you would be able to adjust the portfolio strategy.
Thank you for that, Miguel. Thank you for your views, Miguel. So the fund's objective is not only to grow your capital, but also preserve it. So for those who have a risk appetite that is conservative or moderate and cannot handle the volatility of equities, I would definitely recommend this fund for you. Before we move on, I would like to remind everyone that there will be a Q&A section. We are currently receiving your questions. Please keep them coming for a chance to win ATRAM merchandise. So moving on to the best performing fund in our sleeve is the ATRAM Total Return Dollar Bond Fund, which has generated a return of 6.06%. If we compare the fund against its peers, the fund ranks first in all dollar fixed income mutual funds in the Philippines with a long-term time horizon. Let's call on Delvi Ulpo, who manages the ATRAM Total Return Dollar Bond Fund. Hi, Delvi.
Hi, Mika. Good to be here.
Hi, Devi. So prior to rejoining ATRAM, Devi was actually formerly based in Hong Kong and worked as an Asia credit analyst as well as a trader in Pan-Asia credit hedge funds. Devi also works closely with Miguel in terms of strategy and execution of the strategy. So Devi, the ATRAM Total Return Dollar Bond Fund has delivered very decent returns for 2020. Correct me if I'm wrong, but I believe that the strategy is very unique. In ATRAM, we not only benchmark ourselves to the benchmark, but also against our peers. So we do take a look at what the competitors are doing. How different do you think is our strategy from our peers?
Yep. Yes, Mika, you are right. The fund is very different and very unique. I think in the Philippines, most dollar bonds locally invest in Philippine dollar-denominated securities such as ROPs and Philippine dollar corporates. Also, bank dollar TDs, which offers you nothing. While the total return dollar bond fund can do all of that, I think the difference is it has the ability to be flexible and be able to invest outside the Philippines. And an environment like 2020, it really worked well for us. How is that? I think just to describe, back in the first quarter where you see all those crazy volatility in the market, you see equity market down, everything is behaving crazy. What the ATRAM total return dollar bond fund is actually to reduce the risk and go into very high grade or very safe investment instruments to be able to protect the portfolio. And in times like that, you would want your best investments to be protected. And I think the flexibility of the total return dollar bond fund was able to do that in March. And during the time where the rebound happened, most investors in credit opted to go for sovereign bonds, and we were there to actually capture those capital appreciation. And then as we head towards a year end where the monetary policy is there, fiscal policy is there, market is more stable, interest rates have somewhat died, the interest rate uncertainty and the market uncertainty have died down. We went to higher risk markets such as credit, and an improving environment towards the end of the year actually helped credit, and the ability of the fund to go to places where it will have the opportunity to protect itself and at the same time gain those total return opportunities. That's the reason why the total return dollar bond fund delivered this much, 6.06%. And if you compare this to dollar time deposit, I think dollar time deposit right now is 0.125. So it's close to nothing. The 10-year US Treasuries is around 1.15%. That's a 10-year. If you hold, as Miguel mentioned a while ago, if you buy it for 10 years, you're just going to earn 1%. If you buy an ROP 10-year, which is yielding around 1.65, 1.7%, then you're just gonna get that. But the opportunity to be able to go to places, find the right opportunities, you will be able to get this type of return for dollar bond fund. And even though it's a little bit agile and finding the right spots, it still maintains that type of protection that dollar bond or bond funds in general offer you relative to the uncertainty that the equity market will give you. So I think for those of you that have dollar assets, the total return dollar bond fund is a perfect place if you want that type of protection and opportunistic type of investments.
Thank you for that, Devi. So last year, the performance of the total return dollar bond fund, the positive performance is attributed to active management trading in the credit space as well as trading in the sovereign bond space. I know last year we held in bonds, US Treasuries, which you actively traded. Um, um, could you share with us your outlook for global fixed income as well as your return target for this year, Dev?
Right. So for this year, I think everyone is hopeful. Everyone thinks that the global economy will be successful because the policymakers are there to support us. That's why you see a gradual increase in interest rates for medium to long term type of horizon. So the increase in interest rates actually reflect that positive expectation. And although it's common for everyone to think that rising interest rate is bad for the bond market, actually you can look at it differently in the sense that increasing interest rate environment actually increases your potential to get better interest income than where we are today. So as that interest rates go up, I think the bond fund will be able to capture some opportunities here and there. And just like in 2020, where we think that interest rates will have some sort of variability up and down, those will be the types of trading opportunities that the bond fund will capture. Credit is also a space we're looking at for the year. So similar with equity, the better story of recovery is good for for the credit markets. But that type of income stability on top of the dollar sovereign and the rates trading will be able to help us deliver. I mean, we would like to get another 6%, but as Miguel mentioned a while ago, the ranges is closer to because the interest rates direction is going up, so the ranges will be around 4 to 6% next year.
Thank you for that, Debbie. So I agree with your statement. In times of volatility, there's actually a lot of opportunity, which is why we're able to generate such returns for our funds. Thank you for sharing your insights. As you've heard it, if you do have dollars, it is best to actually invest in a fund rather than holding it or putting it in time deposit, which actually earns you nothing. So I would also recommend the ATRAM Total Return Dollar Bond Fund for any of your dollar exposure. Last but not least, thank you, Debbie. Last but not
Thank you
least,
very
I
much,
want to
Mika.
call thank you. I want to call Evan Ante, our portfolio manager for local and global multi-asset strategies. So
Hi, Mika. Thank you.
Hi, Evan. So Evan manages the Unicapital Diversified Growth Fund, which has generated a return of 6.78%, outperforming its benchmark by 5.32%. Evan also manages the ATRAM Philippine Balance Fund, which has delivered a return of 4.79%, also outperforming its benchmark by 300 basis points. So if we take a look at its performance against peers, the Unicapital Diversified Growth Fund is ranked first, while the ATRAM Philippine Balance Fund is ranked fourth out of 30 peso balance funds in the Philippines. Very impressive performance, Evan. I mean, your strategies are in the top 5 last year. So for the benefit of our viewers, can you explain
Sure.
the difference between the two strategies?
Sure. The key difference between these two multi-asset strategies are really the opportunity set, right? Philippine Balanced, based on the name, focuses on local Philippine assets, so Philippine fixed income and Philippine equities, while the Diversified Growth Fund can invest globally. So the Diversified Growth Fund is diversified in terms of currency because we invest in dollar assets. It's diversified across asset classes, so you can invest also in global equities and fixed income. If you want to invest in the SPX or in the US, Europe, or Japan, we can do so. We also do alternatives. Primarily, what helped us this year was gold ETF. And now we are looking for a broad commodities exposure. For example, oil or copper or through an ETF. So it's an equity fund. And it's also diversified with countries. So like what I said, you can do countries, right? But also within countries, you have sectors. Like in the Philippines, you have property sector in the PSEI, or you have industrial sector. Also in, for example, China, if we believe that China is going to grow next year and you want to participate in that, specifically for the tech sector, we invested in that also for this fund. So it is a very diversified approach that does well in very, like what you were mentioning with Debbie, very uncertain and volatile environment. We can be very dynamic in both funds. We can go to either overweight or more equities or more fixed income, more alternatives, or even cash. If we think both fixed income and equities are gonna go down based on the macro data that we're looking at, then we can go to cash and really protect the capital. We're not shy about being defensive, and we're not shy also at pouncing if there's an opportunity. So we designed these portfolios really to withstand economic shocks and participate in any recovery like we are expecting this year. So if you want to stay in the Philippines because you're more comfortable and with Philippine assets, then you can do Philippine Balance Fund. But if you want to diversify again globally, but you don't have US dollars, don't have to buy US dollars, this is a Philippine denominated fund, then you can pick ATRAM Unicapital Diversified Fund for your exposure.
Okay, thank you for that,
I hope
Evan.
that explained it well, yeah.
Yes, absolutely. So clearly, the difference between the two really is the Unicapital Diversified Growth Fund has exposure to global assets. It's peso denominated but has exposure to global assets, while the ATRAM Philippine Balance Fund is concentrated in the Philippine market. So thank you for that, Evan. Could
Sure.
you could you take us to your asset allocation decision for last year and how you were able to generate such positive performance for the funds? Let's
Sure.
start off with the Philippine Balance Fund. How was your allocation like for how did you handle this whole COVID situation?
Yeah. So initially, when we started the year, everyone was already, like this year, very bullish in 2020. No one saw COVID and everyone is seeing positive returns, right? For the year. Because usually, start of the year, everyone's positive. But having because we now have a global mindset, so we look at China, we look at Taiwan, and in 1 week of January, we saw a lot of news that are not really in the media yet or the main media that there are a pandemic in China. So obviously in China, the information is it's not too widely distributed. So we looked at Twitter or Reddit to look at what's happening there. So we saw that people are falling down just in the streets, right? So you were like, oh, what's happening? And then when we continued to develop, when it continued to develop, then we were like, this will be a bad thing for equities in general, because if you now have a pandemic, it's going to impact a lot of the activity, economic activity. Everything's going to be locked down. So what we did in tactical asset allocation is we started the year with an overweight position in equities. We trimmed that position back in January, so we're neutral in January, and we went underweight equities in February. Because if you remember, when people say, oh, this is just like a flu, right? The COVID is just like a flu. It's not bad. It's you can't get it. You can only get it in like surfaces. It's not airborne, etc. So the market rallied back globally. People thought it's nothing. So when it rallied back, we thought, oh, it's a perfect time to sell because we think this is not going to happen. And remember when we were still accepting Chinese tourists in the Philippines, even though there's a pandemic in Wuhan. So we were like, oh, it's not going to end well. And so we turned bearish equities. Having said that, that did well for the portfolio, right? We were going to the pandemic and into March 16, we were super underweight equities. But at the same time, when we saw that it went to 4-1 intraday in one of those days, we thought that, oh, I think this is overdone already. People priced in a lot. So what we did is we added our position. We added our equity position by March, and then by April we are neutral already equities. We thought there was a possibility of recovery. It was overdone. So this is very important because we don't only look at macro data. We don't only look at valuation or fundamentals. We also look at sentiment. Also look at what's priced in the market. We looked at the technical analysis. So we combined those and we use that for our tactical asset allocation. And then moving forward, so back in June already, so there was like a big consolidation after that April to June rally in equities market. So we were neutral. And then finally, we thought, because we were also looking at global markets, that there are more recoveries there, despite the Philippines being much of a laggard in terms of lockdowns. So we said, we are laggards in the Philippines, but we will recover. So we went overweight Philippine equities at the latter part of the year, and that did well for the portfolio. So we protected the capital start of the year, and then we turned neutral when everything seems to be improving, and then we turned overweight equities when we thought that the recovery is now the main expectations for this year. And in anyone, obviously investors, everyone looks forward, not in the past. So we think that it was going to be priced in, and thus we moved. So,
Very-
so that's for Philippine balance, sorry. And then there is the diversified capital growth. So for the Philippine assets of the diversified fund, it's the same. We did the same movement. So we were underweight equities, overweight fixed income. But for this particular fund, because we can go globally, what we did is really we added a gold ETF, because in high volatility environment, in a risk off environment when everyone's scared, gold usually does well. Not only that, the central banks lowered interest rates, increased their balance sheets, and increased the money supply of money, and that usually bodes well for gold historically. So we added gold, we reduced equities, we reduced both Philippine and global equities. We increased our US Treasury bonds position. We increased our Philippine fixed income bonds position. So that's what we did in the first quarter. And then after that, like what we did in Philippine Balance Fund, we added exposure to global equities gradually. But the main thing about the Dynamic Growth Fund is that we can also select sectors that we think are going to benefit more. In COVID, there are winners and losers, right? Sectors. The hospitality and tourism sector was badly hit, but the tech, healthcare sectors were beneficiaries. So that's what we did. In global equities, we did not only add in an index fund, but what we added is sector specific. We added US technology, Chinese technology funds, and also healthcare funds, because we thought those were the beneficiaries. So that's what we did as we moved through the year.
Thank you for that very
Sure.
comprehensive discussion, Evan. So it's clear that the Philippines actually, there was a lot of things going on in the Philippines in 2020, volatile Europe, and then eventually COVID accelerate. So a very proactive approach on your end to kind of reduce exposure reduce the exposure of risk before it got really bad, and add the risk back when we knew that things were sort of easing up. I have another question, Evan. Would
Sure.
you please share with us your 2021 views for the market, and how does this affect your strategy?
Sure. So 2021 is turning out to be like the start of 2020, right? Everyone almost agrees on everything. We enter January when investors are largely positive on risk markets including equities, credit, and commodities, and relatively bearish on government bonds because inflation is increasing a bit, and there are low yields already, like what you guys mentioned earlier. This is because on top of the reflationary bias, because now we are in a reopening cycle. Everyone's expecting the economy to reopen gradually. Also because there are vaccines available, right? Obviously, it's not yet here. We expect the vaccines to be distributed by the start of the second quarter, and hopefully in the Philippines, we do a mass vaccination by the end of the year. So just for a macro perspective, I have three factors that I looked at that enables us to be more positive risk. Right. First is really there's a synchronized global recovery in place right now. We expect a 5.9% global GDP growth in 2021, and this is really coming from a low of 3.7% down last year. So obviously, this is not just a low base effect, but that's obviously a factor. But also, well, like I've mentioned, there's a reopening in place. There are pent up demand in place. So when we finally reopen, everyone's going to go out and spend, especially in the services sector, which is the most badly hit sectors in the economy. Second is that monetary authorities will continue to keep the interest rates low. Everyone is saying, from central banks here in the Philippines to the Fed to Europe to Japan, that they will not increase interest rates until this COVID-19 threat dissipated. So that's positive for risk assets because like what everyone's mentioning from equities and fixed income, if you can't get enough return in fixed income for your hurdle rate or for expected return, then you would be forced to really invest in riskier assets. Obviously, riskier assets give you a higher expected return, but also higher expected volatility. So it's a trade-off. At the same time, that loose monetary policy, low interest rates, and bond buying by central banks, that coincides with a very loose fiscal policy. So governments are spending, they're borrowing and spending because the private sector can't really spend because they're scared. So what happens in these kinds of times is government must spend, and that's what they're doing globally. So the combination of loose monetary and fiscal is very positive for the economy and for risk assets. Lastly is the vaccine, right? I think in the Philippines, you've already ordered a lot of vaccines. I'm not sure if this is enough for the herd immunity levels that we need to be so that we can finally fully reopen the economy. But the combination of those three factors makes us more positive equities or risk assets, including credit and commodities, rather than fixed income. But obviously, there are nuances to this view. Like for the first quarter, there's no yet vaccine. We are seeing lockdowns still in place. So maybe the first quarter is still low. But starting second quarter, third quarter, fourth quarter, that's going to change. We expect the recovery to fully start. So right now we're a bit in terms of strategy, we're a bit neutral to overweight equities in global equities and Philippine equities. We actually took profit earlier the month when everything is going up, and we're less bullish now. But we are on the lookout of positive opportunities. So like what I said, it's a very tactical and dynamic process. If there are opportunities in fixed income, we're not shy to add, even though our long-term outlook is less bearish in fixed income. If there are money to be made in either asset class, we will do so. So in summary, Mika, so we are currently overweight equities and alternatives through ETFs and a bit underweight fixed income.
Thank you for that comprehensive view, Ivan. So Ivan also actually manages the ATRAM Asia Plus Equity Fund, which has delivered a return of 16.99%. Whoa, that's big. Can you just share with us how you were able to deliver such high returns, and where do you attribute the performance?
Sure. Thank you. 17% is pretty big, especially compared to the Philippines, right, when we were down. But really, 2020 was a great year for North Asia. And what's North Asia? That's China, Korea, Taiwan. It bolstered the majority of the Asian region because they have a lot of weight in the indices. So why? Because they contained the virus early. They had systems in place because of SARS already. So they were able to really manage the virus well. They employed effective monetary and fiscal tools to their limit. North Asia countries really reopened the countries earlier than everyone. So if you look at the three countries that delivered positive GDP growth last year, there are only three. So two of them are in North Asia. So that's Taiwan and China. The other one's Vietnam, but that's ASEAN. But that's the thing. So Asia did well in this kind of environment. So because of that, Asian stocks recovered faster and also moved ahead of 2 years ago's level. So that really is the case. So like what I said, what to attribute our performance, China really was the biggest performer, and Korea. So we were overweight North Asia last year. So we were overweight China, Taiwan, and Korea because of the virus management, and also they have exposure to tech. So the Chinese tech companies are really good now because there's a bifurcation between US tech and China tech. So the Chinese government is spending a lot of money to bolster their tech sector. So that's good for Chinese tech companies. Korean tech like Samsung, right? And Taiwanese is like the biggest foundry of semiconductors, the Taiwanese semiconductor company. So we were overweight there. That's why we had this return, and underweight ASEAN countries like Malaysia, Thailand, Indonesia, and the Philippines, because we were late in the various management game. At the same time, we are more cyclically oriented economies. Our sectors here are more industrials, property, and tourism. So that was badly hit by this pandemic. So that's how we positioned last year.
Okay, thank you for that, Yvonne. So the performance is attributed to our exposure to China tech funds as well as South Korea ETFs. But this fund is diversified. You have positions in Philippine equities, Vietnamese, Malaysian equities as well. Do you think the same return still applies for the year? What are your return expectations for Asia equities for the year, and what's your target return?
We hope to have the same return, but given the elevated levels and valuations this year, and also some of those recovery pieces has been priced in earlier than expected, we think it's not going to be as high, but we think it's going to be around 11 to 12% this year. So that's really going to be, if we're gonna go there, it really has to be driven by China, Taiwan, and Korea, because those have the biggest index weights in Asia, ex-Japan. At the same time, right now, the thesis really is more of a combination. Before, last year, it was more the winners of COVID. But this year, it's a combination now. It's a more broader rally. It's not only the winners of last year of COVID, but also the losers, or the badly hit sectors and countries. So what we're doing now is it's going to be a broader rally. China, Taiwan, and Korea will do well. But at the same time, we think Philippines, Indonesia, Taiwan, Vietnam, and even Japan will do better in a cyclical recovery. So that's why we are expecting 11 to 12% this year. There might be a lot of volatility. The momentum is still in place. But we think there's a positive momentum, because also EM, or emerging markets in Asia in general, has been underperforming developed market peers, Europe and US, for 10 years. So finally, hopefully, we outperform in the next decade. And obviously, Asia is the one that has the biggest population, so we have a lot of runway for growth.
Okay, thank you for sharing our global views, Yvonne.
Sure.
ATRAM has a wide range of investment products, and our capabilities span across several asset classes, meant to service the different investment objectives of each individual. For today's session, we hope to have somehow helped you in your investment journey. At this point, we would like to move on to the live questions from our audience. We do have several questions coming in. Let's start with a question for June. Hi, June.
Hi, Mika. Yes.
Hi, June. Yes,
What's the question?
Yes, do you have an estimated timeline on when the vaccines can be deployed in the Philippines? And do we expect PH corporates to recover by 2021, or will we have to wait until 2022?
I personally don't have a timeline for the vaccine, but from what I've read, I think the first set of doses is scheduled for February 2020, and then the next one is in the second quarter. But I think more importantly, what we are focusing on, because our view is eventually consumer, whether it's that or something else, consumer confidence will return, and the market and the economy will get back and to even and maybe I'm optimistic and sure that it will go higher than the previous levels eventually. So what I look at is more of like, how do the valuations? I understand the market's not that encouraging, at least for January being down 7.5%. But I mean, if I look at the earnings yield of the market, which is the inverse of the price earnings ratio, I'm getting about almost 7%, 6.8, I think, on 2022. And again, even if the market or the economy and earnings won't go back to 2019 levels this year, we're going to see a sharp recovery rebound already. Full recovery, we think, will happen sometime in the second half of or by mid-year of 2022. So that said, we're looking at values this year, where the value is, where the growth is, rather than focusing only on the vaccine, because I mean life goes on, and um, Filipinos are resilient, and you will see that shine through, I think, over the next year or year and a half.
Thank you
So
for
this is
that,
an
June.
opportunity for for looking at value and growth.
Okay, thank you for that, June. I have a
Welcome.
next question for Miguel. Interest rates are at all-time lows. At some point, they should rise back to normal levels as the crisis recedes. How will the bond fund position itself for this?
Actually, that's an excellent question. I just want to draw attention to that point that that's absolutely correct. Coming from the low levels we saw at around July 2020, those are not just 2020 lows; those are all-time lows for government securities. And actually, with what I mentioned earlier, the view is that inflation will continue to adjust higher from here. At best, it will stay within this 3 to 3.5% range. But I completely agree that the onus is for inflation actually to probably move up. And that's why I know I'm harping on it again, but that's why the active nature of the funds management I think is key, because we do agree that rates are going to go up, but when is that going to happen? I think that the BSP is not going to be inclined to raise rates anytime soon, while our own belief is that they may cut the reserve requirement and may not cut the overnight policy rate. If there is a risk to that view, it is that they actually cut the policy rate, just because, as we know, GDP came out last week worse than expected. While we're optimistic on the reopening of the economy, there's still a lot of questions on that. And if there would be any action, it would be actually to send rates lower, at least in the short term. So what's the strategy? The strategy is to kind of look for those signs, whether inflation is actually about to show up again, and then adjust the portfolio. Just talking about where we were at the end of 2020, as I mentioned earlier, we were holding no 10-year, we were holding no 20-year, we were holding short bonds. What are we doing today? Well, to Mika's point earlier, we were buying 10-year at 306. And again, no intention to hold this to maturity. No intention really to even hold this till the end of the year. We're buying it today at 306 because we think that in 2 weeks' time, this is going to be below 3, at which point we will sell it, look for another opportunity, look for the next opportunity, and adjust the strategy accordingly. And I think that that's what's going to be happening for the balance of the year. You won't have a clear directional move higher or lower in rates, not like you saw in 2018, which was just up all the way, or 2019 and 2020, where it was just down all the way. I think you're going to see a tighter band, but more volatility of trading within that range. And I think historically, that is an environment where we've been able to show that we've been able to call it right. And that's where I think the opportunity will come from.
And I'm actually a super huge fan of the fixed income strategy, active management, duration management. I think
I hope you're invested in the funds then.
Yes, of course.
Yeah.
So the calls have been spectacular. Thank you for sharing that with us. I have a question for Devi. For the same financial goal and same availability of investment fund, what is better to use for investment now? Do we go through a peso or a dollar investment?
Right. So I think it depends on where do you use those assets. Meaning, do you intend to keep the peso in peso for longer, or do you intend to keep dollar for longer? Though? I think in the short to medium term, although the trend for the peso is to strengthen because of the weakness of the dollar, as the economy reopens, the dollar will be favored because the government will be importing goods, and that's a demand for dollar assets. What we believe is important is that if you have dollar assets, keep it in dollar, that because you'll be using it for dollar, and do not park it into almost zero time deposits. fixed income instruments in dollar, I think it's best to put it into an actively managed fund, such as the total return dollar bond fund. If you have peso asset, and I mean Miguel mentioned it, that's also the way we're trying to we're managing the assets. And if you don't intend to put it into risk, put it in a total return peso bond fund. So I think over the course of the short to medium term, if you want safety, and if you want a little bit of certainty on the return potential of your portfolio, go for bond funds. But if you want to have more capital appreciation, then you'll have to like balance it out with a little bit of more risk assets such as equities, which we are positive as June mentioned a while ago.
Debbie, could you share with us our fixed income views?
Right. So for peso, as Miguel mentioned,
Sorry, not fixed income, FX.
Oh,
views.
FX. All right.
My bad.
Sure. So I think the owns for the peso is to weaken against the dollar, not because the economy is weakening, but because there will be more demand for dollar once those government expenditure happens. And you look at the news, it's very intuitive that when you build roads, you import steel and those types of purchases. That didn't happen much in 2020 because there's no laborers to work on the roads, work on the buildings. But for this year, because the economy will pick up, importation will pick up, and that's a big demand for dollar. Although we do not really see a significant amount of dollar appreciation, but against the peso, there will be a little bit of tick up on the dollar peso. I think 48.50 would be something that we'll look forward to, or weaker than that.
Okay. Thank you, Dev. Thank you.
Sure.
I have a question for Yvonne. Is there a specific region in the world, US, Europe, Asia, where we should put more weight in our investment portfolio? Which region would you think would recover the fastest from this pandemic?
Just in general, I mentioned earlier that this is now a reflation story, a recovery story for this year. So we expect growth to be high. So that implies also that the ones that will grow the fastest are the ones who lost the most last year, right? At the same time, if you have early virus management. So those two factors are the factors that I'm looking at, which ones will do well. So first is Europe, second is Asia. Those two countries will grow faster than everyone in terms of GDP and earnings growth for next year, based from our analysis. But having said that, in our portfolios, we don't necessarily use only that kind of fundamental data to say, oh, we're going to be overweight US or we're going to be overweight Europe. It's more of it's a combination of a bottom-up approach and a top-down approach, right? So we combine those. So if, for example, this is an example, in our multi-asset portfolios, we are currently underweight US, but overweight Asia, specifically emerging markets Asia. If you include the Philippines, we're super overweight Asia. Why? Because we think, like what you were asking, there's growth to be had next year. And the sectors, based from our bottom-up analysis, will do well also next year. Tourism, property, consumer discretionary, while at the same time, even though we're underweight US, we're not as underweight US because we still believe that the winners, the structural winners of COVID, and those sectors that have long-term growth rates, positive long-term growth rates like healthcare and tech, will still be positive. So it's now a combination. So to summarize, we expect Asia and Europe to grow the fastest. But for our strategy, we don't use that only as those factors. We combine bottom-up analysis. And in general, we're underweight US, underweight Latin America, we're overweight Asia, and a bit neutral in the UK and Europe. and obviously positive on the Philippines.
Okay, thank you for that, Evan. So,
Sure.
overweight in Europe and positive in Philippines as well as Asia geography.
Mhm.
June, I have another question for you. Is it the best time to invest in REITs, especially now that NCR and the rest of the country has reverted back to GCQ?
Um, I think it's a good investment. REITs are a viable investment, particularly if you're looking for income in an equity structure. So if that's your objective, then it's okay to invest in REITs. I think the A REIT right now has a yield of about I think 2 to 3% at these price levels. So if you're okay with that, then REITs is okay for you. But as I mentioned earlier, looking at the earnings yield of the market, it already presents quite a sizable yield at this level. So I would probably look at have a preference towards the equities market in general, unless you have a REIT that gives you a more substantive yield. That's just me, but if yield is your objective, it's I guess it works. It may work for you.
Okay. So Sir June, what is your projected return for the Alpha Op Fund this year?
Oh, that's a tricky one. As mentioned earlier, we're looking at a 21% return for the market from these levels. That's an index target of about 8,300 for the PSCI by year end. So Alpha Opportunity um, uh, characteristically outperforms that. So we're looking at a return higher than 21%. We still expect it to outperform the market. I think year to date, it's even if the return was negative, the outperformance was still there against the PSEI.
Yeah, so the Philippines does have a lot of catching up to do. We still haven't fully recovered from the 2019 level of the PSEI. Miguel, I have a question for you as well. Same question. What is your projected return for the Soldiva Bond Fund?
Sure. Well, I mentioned earlier, I think there will be opportunities. Um, Unfortunately, the 8% that we generated last year is probably not very likely. I think somewhere in the range of between 3 and 5% is still quite doable, which is, I feel, quite a decent return given that buying 10 years today is at 3%. So I think the volatility will allow for some capital generation opportunities for the fund. So between 3 and 5%, I would say.
That's still very good. I believe 3 to 5%, very good return, given where current yields are right now, and and of course you will be, if yields do start going inching up higher, you will be having like a defensive approach, which will help and preserve the capital of our investors. Um, I have a couple more questions. Evan, what is your suggested asset allocation strategy for the year considering our situation?
In general, how we are positioned for global multi-asset portfolios is really overweight equities, so both Philippine equities and global equities. Now you really have to be picky now. Um, last year sometimes whatever you bought went up, right? After the crash, that is. But I think that's why it's very important to have active managers like June, who is a very good stock picker. Now it's a very stock selection or sector selection game. So that's why even though we're overweight equities, you have to be really looking which kind of sectors or companies do you want, because it's not going to be the same across. So overweight equities. And then for fixed income, we're really fortunate to also have Devi and Miguel with our team because they can actively manage our portfolio. Even though we're underweight fixed income, that's our call for multi-asset so far. It doesn't mean that they cannot play around their strategy within fixed income. You can either be aggressive or defensive, right? And that's what that's what they're able to do every year, and that's why we're very confident in using their portfolios as our fund in multi-asset. And then lastly, we're overweight also in alternatives. through ETFs. So in this kinds of scenario, when there's a recovery and coming off of a 10-year bear cycle in commodities, we think that broad commodities will do well, both because there are supply constraints, and at the same time, in the middle of the year, there might be pent up demand, like what I was saying. So a combination of decreased supply and high demand will, we think, be positive for commodities. Not so these are commodities. When I mention commodities, not only precious metals like gold, but also base metals or industrial metals like copper, nickel, cobalt, nickel, or agricultural commodities like corn, wheat, etc., or livestock. You know that the pork and chicken, there's a price cap now because the prices are high. From that perspective, if you're an owner of those livestock, higher price is better for you. But as a consumer, obviously, it's bad. So, in summary, overweight risky assets, so equities in credit and commodities, and underweight fixed income, primarily government bonds.
Thank you for that, Evan. Any last words from our speakers, perhaps? Any parting messages? June? Miguel?
Sure. I think, well, now that you've heard our outlook, I hope that everybody continues to have I think, diversified portfolio. Very difficult to say what's going to happen this year, just like it was last year. But one thing I think everyone can agree on is that it's probably still not safe to put all your eggs in just one basket.
Thank you, Miguel. June?
Yes, thank you, Mika. Just wanted to thank everyone for dropping in today and for listening, allowing us to share our views. Maybe one last note. There's a reason we have the word opportunity in the names of our funds, and it's because we're always that's what we do every day. I wouldn't say that's what we live and breathe every day, but it's an integral part of our day, and we do it professionally. It's to spot those opportunities for you. At the same time, having a very, I think, deep or strong risk management process to go alongside that. And lastly, this is a year, I guess the reason I said that is this is a year of opportunity, and pair that with a good risk management platform and asset allocation. I think this is a great opportunity for everyone this year, last year, and this year. So thank you again for joining us.
We agree. Thank you again, speakers. Thank you, Miguel, June, Devi, and Evan. Okay, I'm sure you guys are interested to learn about how you can invest in ATRAM funds. May we call on Nika Lim to tell us more.
Good afternoon, everyone. To open an account with ATRAM, just visit our website at atram.com.ph. Here, you can learn more about all the funds we offer. It will then guide you to our online investment platform, Seedbox. But if you have more questions, visit the website's frequently asked questions page or ATRAM Academy page as well. It's as simple as that, so I hope you do visit our website at atram.com.ph. Thank you.
As promised, here are the winners of our ATRAM merchandise. The winners will receive a collapsible mug. Congratulations to all our winners. We will contact you separately in the registration on how to receive your prize. Once again, thank you to our speakers, and of course, thank you to our audience. We appreciate you taking the time to join us today. If you have any further questions or would like to learn more about ATRAM, please visit our website, www.atram.com.ph. If you have not registered for our next webinar next week, Evan will be back to discuss the ATRAM Philippine Equity Smart Index Fund. You may join us next week by scanning the QR code flashed on the screen. You may also type in the link found on the left side of your screen. We do have other webinars lined up for the rest of the month. Please tune in for that as well. I would also like to invite you to join ATRAM's new official Viber community group, #ATRAMPH Community. To stay up to date to the latest announcements, advisories, and reminders, scan the QR code or visit the link bit.do youtube.com/ATRAMPH. If you have any friends who you think would have liked this webinar but was unfortunately unable to attend, feel free to share the YouTube replay of this session. Visit our YouTube channel, ATRAM Studios. Lastly, we would love to know your thoughts on this first ever Ask ATRAM session. If you have some time, may we request for you to answer the survey at the end of this webinar. On behalf of everyone at ATRAM, thank you again for your attendance and participation. We wish for the continued safety of you and your family. Have a great day.